The gold price is rising despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing that I could buy, which is treasury bonds? What will they give me in 10 years or 20 years? Will I be able to buy something with them?
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, a retired wealth manager. Clive, thank you so much for joining us today.
Hello, Elijah. Hello to all your viewers, and thank you very much for having me back on the show. Big day today, Elijah. Gold has hit an all-time record in just about every currency except the dollar. We're at an all-time record in pounds, euros, Swiss francs, Canadian dollars, Australian dollars, and probably a whole bunch of other currencies.
Definitely. We are recording on January 16th today, evening time where you are in Switzerland. But I wanted to ask, why do you think gold is rising so significantly today?
Well, could it be that world peace has just been declared? No. I think actually what's really going on, it's all related to the government debt. Government debt is rising faster than it's ever risen in history. It's not just the USA, it's around the world. Governments have got into the habit of overspending, starting with the global financial crisis when they bailed out all the banks. And then we went through the COVID crisis where they printed money willy-nilly to help all those people who were furloughed or lost their jobs and that sort of thing. And having got into the habit of spending money, not only on those types of things, but other things as well, for a while, there appeared to be no negative impact. So these habits of spending more than they're collecting in taxes continued and have got worse. Now, I'm talking about democratic countries here where it's very difficult for a politician to put his hand up in the air and say, all those benefits we were giving out last year, we've got to stop it now. So cutting the spending is very difficult. There'll be rioting on the streets if you try to do that. Raising the taxes, they're trying to do that, but you can only go so far. If you raise taxes, it stifles economic growth. In the end, the result of that will be lower taxes anyway. So there's not really a very easy answer, but the debt is rising quite fast. We've got interest payments on that debt rising much faster. And the reason for that is that a lot of that debt, which was taken out over the last 10, 15 years by governments, was taken out at a time of zero interest rate policy, ZIRP, Z-I-R-P. So that meant that the interest they were paying on the debt was very low. That debt is reaching maturity little by little over the next decade. So as it matures, they have to borrow the same amount again, plus all the interest, but they're borrowing it at a much higher interest rate. So the interest is rising fairly rapidly. And that means, when I say fairly rapidly, I mean, it's quite dramatic. And there's a real possibility that within 10, 15 years, the interest payments by governments will be exceeding the totality of their tax take. That's a possibility. Certainly it will be happening if nothing changes by the time my children are coming into retirement. So I don't think there's a lot of hope for the next generation in terms of being able to repay that debt. I think the governments are going deeper and deeper into debt. They don't have a way out. They don't know how to get out, and I don't know the answer. So, where's it all going to go? And I think people are saying, I'm not going to get paid back in something which will buy me something. I might get paid back my money, but what will I be able to do with the money then when there's so much of it? So I think people are saying gold is my plan B, it's my parachute, and they're buying some gold to store value. And of course, we've got the central banks now seeing the same thing. We've had quite a bit of buying last year from countries like Poland, and obviously China was one of them. And I think although China wasn't the biggest buyer of gold last year, I think Poland was, people are taking their lead from China, who in the month of December bought twice as much gold as they bought in November. In November, they had, that was after a several month break when they hadn't bought any gold. But the increase in China's reserves over the last 12 months, 80% of that increase has come from gold itself, a mixture of buying gold and the rise in the gold price. Now, what that's saying, China is buying gold, and gold's at an all-time record. They are valuing gold more than any other asset they could buy. So I think other central banks are taking notice, and it'll take a long time for central banks to react to this, because if you're going to increase your gold holdings in any central bank, you've got to have your legal department on side, you've got to have the compliance department on side, the risk department on side, the management on side, the investment department. There's going to be all these different departments, the economics department, who've got to be consulted, brought on side before they start to buy gold. But little by little, I think other central banks will be following suit in the wake of what China's doing. And I think those who can see that that is coming are saying, well, I don't want to be the last one to the post. So they're starting to buy today. And that's why the gold price is rising, despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing I could buy, which is treasury bonds? What will they give me in 10 years or 20 years? Will I be able to buy something with them?
I think there are fears of inflation here. Now, well, you mentioned interest rates rising. We've seen the 10-year treasury yield significantly rise over the past few months here. As the Federal Reserve has been cutting, we did see a reversal in the last couple of days, but this is a very strange phenomenon we're seeing when the Fed is trying to lower interest rates, but the market is saying, no, we need higher rates.
Well, yeah, in simple terms, the short-term rates, the overnight rate or the Fed funds rate, is down by 1% in the last 6 months. And the long-term rate, the 10-year rate, is up by 1%. So we've had the two rates move in completely opposite directions. And the reason why that's happening is, I think people are saying, there is this huge borrowing requirement which is happening, partly due to the rising interest costs of the debt and partly due to the expanded budget deficit, with no real plans to address it at the moment. They may come, but they're not there yet. And people are saying, if this continues, investors like me are going to get indigestion because I can't afford to buy any more treasury bonds. At least I'm not going to buy them at 4.5% anymore. I need 5% or 5.5%. Now, there will come a point when that interest rate, which the government would have to pay to borrow money, will be unpalatable for the government, because it will be accelerating the spiral out of control. Instead of a slow, painful death in the value of government bonds, it could spiral into a very rapid decline. So before we get there, and we won't get there, but before we get there, the Federal Reserve will be asked or invited or instructed or ordered, or will just decide on its own, to step in and start to buy the bonds from the primary dealers, which the government is selling the treasury bonds to the primary dealers to raise cash. The primary dealers will be selling them to the Federal Reserve, and the Federal Reserve will be expanding its balance sheet, because where's it going to get the cash to buy those bonds? Well, the way it's always got the cash in the banking crisis and the COVID pandemic, and the way they will do it next time, which is coming soon, they will print money. So what we'll see is an expansion of the money supply as the Fed prints money to buy those bonds, and they'll be buying the bonds to stop the interest rate or stop the yield of those bonds rising beyond a certain point. And of course, we all know what that will mean. It'll mean a lot of cash entering the system, and someone somewhere is getting all that cash, And what are they going to do with it? Well, they're going to buy tangible assets. They're not going to put it back into treasury bonds unless they think the interest rate is high enough. But the interest rate won't be high enough because it's been suppressed by the Federal Reserve.
You've mentioned in one of your recent posts on your LinkedIn that QE is going to turn to QT is going to turn to QE pretty soon here. So the Federal Reserve will have to do that currency creation more very soon. So your perspective on that, when do you see this happening?
I'm seeing the third quarter of this year, and I'm perhaps a bit late on that because I see other commentators saying it could happen in the first or second quarter. Yes, it could. I kind of think things won't go quite that fast, but we are entering a danger zone as interest rates rise towards 5% and beyond. Where's the cutoff point? Where's the Fed step in? I think the rate is lying somewhere between 5 and 6%. Difficult to say. Is it 5.25, 5.5, or is it 6? But are we on our way to 6%? I think if the Fed doesn't step in, yes.
Now, when it comes to interest rates, though, so with quantitative easing, it's often the Federal Reserve creating currency and pushing it into the system. But do you actually see the Fed reducing interest rates significantly more?
Well, sentiment has been swinging 2 ways or 3 ways, I suppose, in the last few weeks. When they last cut interest rates in December, the view was we'd get 2 more cuts this year. Then as the bond yield started to rise, sentiment started to change, and actually there was some words coming out of Fed saying we're not in such a great hurry to cut rates. So sentiment started to change a little bit along the lines of it might take longer before they cut them, and we might not even get those 2 cuts. But recently, just last day or two, we've had some very good inflation numbers in the United States, and the 2 cuts this year are back on the table. Of course, the Fed can do what it likes at the short end. It can, that's what it controls. It doesn't control the long end unless it steps in with quantitative easing, buying government bonds. So really, the short-term interest rate is what's under the control of the Fed. If they want to reduce it now, they can. They've got full justification for doing so on the grounds of those recent inflation numbers. So I think it's likely they will while they can. But whether it be 1 or 2 cuts, we'll see. But I think after that, people will be starting to talk about short-term interest rate rises again. If there's some sign of inflation resuming. And there are early signs that might be coming back. We're seeing that the oil price in recent weeks is ticking up quite sharply. And of course, any escalation of tensions will cause supply chain bottlenecks for the shipping routes. So we've actually removed the bottlenecks we had a year and a half ago, 2 years ago, so we had higher prices a year or 2 ago because of the war in Ukraine as things started to seize up a little bit. And then there was the COVID before that. So we're coming out of that. So these higher prices are coming off their peaks, which means we've had up until now the benefit of, when we look back a year, looking back over 1 year at peaks. So we're obviously in many products lower than we were a year ago, but having seen that decline, we're no longer at peaks. So when we look forward a year, it's quite possible that the prices will be up and rising again. There's no hill to come down anymore. We've come down the hill. So can it go down the hill further? I think it's much more limited now. So yeah, I think inflation will be coming back, and I think the Fed at that point will have to be thinking about what it does. Will it change its 2% target? I think it will. I think it will probably change the 2% target to 3%. It won't be alone. I think the whole world will do that. Currently, they're sort of sitting at 2%, but looks like it's an unachievable target. So I think we'll probably see some sort of collective decision as they gradually, central bank by central bank, say our new target is 3%.
And when the average percent, when they say 2 or 3%. Typically, how that really impacts the average person is it's going to be more like 6 or 7% because the government can really, play with those numbers to get the number down low. But how it really impacts the average person is going to be probably a lot worse than that.
Yeah, I mean, a lot depends on how you spend your money because everybody's inflation rate is different. But I think the main thing to say is the consumer price index isn't very representative if you are saving for your retirement or you're saving for some luxury later on in your life. The consumer price index is reflecting the prices of goods which are consumed by the masses. And these goods are all produced by robots. As an example, the television one of my screens, that one there is a 65-inch TV. I bought it about, 5-10 years ago now, maybe 15 years ago, I can't remember now. I remember the price. It was 6,000 and something Swiss francs. It's a UHD TV by Samsung. Today, I was in an electronics shop and I saw exactly the same make of TV. It's probably got more bells and whistles than this one. It's got the same number of pixels. It's still UHD. 540 Swiss francs, 65-inch. So 1/10 of the price. So mass-produced items have been coming down in price. But what's not going to come down in price and what hasn't come down in price are the things that you're saving up for to enjoy life in your retirement or when you get older. These are the things which are not mass-produced. They're things like holidays and travel. These are things like healthcare, things like nurses at old people's homes. You want to have to go to a home at some point and be cared for by a nurse who'll look after you, change your nappies or whatever you need. That's not going to get any cheaper. And the price of those types of things will be rising not by the consumer price index, but they'll be rising by the increase in wealth which is being created by the government borrowing money, thus the government gets poorer, and spending that money, and someone gets that money. Who gets that money is those who are successfully saving for their retirement. Let's face it, not everybody can do that, but those who do it successfully spend less than they earn, and they build up a nest egg for their retirement to live off, so that when they get to retirement, they can buy themselves a nice home. Maybe they can do a home extension. Maybe they can have a nice holiday. Maybe they can pay for their grandchildren's education. But all of these things that they're going to spend the money on in retirement, perhaps nice paintings on their walls, it could be anything, they're the things which are in limited supply. And because there'll be far more people like them with far more money, because the government's printed it, or rather the government's spent it and borrowed it, those things are going to be rising at a much faster rate than the consumer price index. So the government's getting poorer to the tune of 7% a year, let's say, in America. That's a very rough and ready figure. We're at, a debt of 35 trillion now, I think, and people say it's going up by a couple of trillion a year. What's that? That's about 7%. I think it's nearer 3 trillion a year going up. But the debt is rising by 6-7% a year. That's way more than the consumer price index. And all of that extra wealth, which is being created as the government spends the money, goes into the hands of someone, somewhere. And at the end of the chain, there are people who are saving that for spending on the luxuries of life, the rarer goods. So, yeah, it depends who you are and where you are in life and what you're going to spend your money on. But you're going to need money which will you're going to need things which are costing a lot more in retirement than the general increase in consumer prices from here.
So how did people then, I guess, prepare? I mean, a lot of our viewers are looking towards retirement. So how do people prepare for that if a lot of the goods and services that they're going to be wanting are going to be extremely more expensive when they come to that point?
Well, first of all, I know that your channel's you quite like gold and silver, but I'm a diversified person. I think the way to play the game is to be diversified in all kinds of assets, and that can include parachute type assets. Gold and silver could be your parachute for a complete monetary collapse. But you also need productive assets, and productive assets include things like equities. Obviously, you need the right ones, and you need some skill to choose those. And if you can't choose them, at least choose a broadly based exchange-traded fund. That's a fund which owns all the stocks in a particular index. I'll just say that I do not like at all the S&P 500 ETFs because they're very heavily weighted. Well, they're totally weighted to the USA. And secondly, they're very heavily weighted to the 7 largest companies, something like 35%, more than 35% now. So what those 7 companies do will be what the ETF does. So if you're going to buy an American-based ETF, probably go for one of what they call equally weighted ETFs, which has 500 shares. Each one has an equal weight. That's a safer approach to have an equally weighted index. But you'll miss out, of course, on those 7 largest companies, which have been the ones going up like rockets and driving the market. But there's no guarantee that will continue. So productive assets also include real estate. Now, there's 2 ways to own real estate. You can buy apartments or houses and let them out, or you can go for a real estate investment trust. That's a fund which owns lots of properties. They do all the management for you. You don't have to do anything. All you do is collect the dividends and you can sell the fund any day. It's highly liquid. Virtually no bid and ask spread, unlike a property where you might spend months trying to sell it. So it's a choice on which one you want to do. You'll probably make more money if you own the property directly, but you'll probably have a lot more hassle dealing with tenants, taxes, repairs, government taxes, and all kinds of things like that. So that's a personal choice to what people prefer. But tangible assets is what you want. What you do not want, if you're saving for retirement, is cash in the bank, money market funds, bonds of every description. That includes government bonds and corporate bonds, or anything which is going to repay you only in fiat, unless, of course, the interest rate is sufficiently higher than the depreciation of money. And given the rate that government debt is increasing, you probably want a much higher rate than 7% today to even justify thinking of it, and even more if you're going to pay tax on it. So really, I wouldn't be looking at bonds or cash or money market funds myself for long-term savings. If you need money for the short term, and you might, like for emergencies or day-to-day living, keep that in short-term treasury bills or cash. But you really don't want to have your long-term savings tied up in an asset which is going backwards, and that's cash.
It is so interesting to think about how, even if you invest in U.S. treasuries right now at a higher interest rate, I mean, you have to look at how much is the dollar depreciating, because people think so much just regarding, the numbers they see on their screen maybe is if they have more dollars, then that means more wealth. But it doesn't mean that, right? You have to look at purchasing power of those dollars, not just the dollars themselves. And I think that's something a lot of people miss.
Yeah, I mean, if you take an example of a multimillionaire, how many Leonardo da Vinci's or Van Goghs can he buy this year compared with 20 years ago, allowing for the, let's call it 5% a year interest he's earned over the last 20 years? Well, the answer is, even though he's earned interest, even though he may have paid no tax, he can buy far less Leonardo da Vinci's. And the same thing would apply to healthcare. The same thing would apply to anything which is in limited supply. There just isn't enough of it around. Of course, we've seen what the gold price has been doing over the last decade. Well, let's say last few years. It had a dead decade. It's kind of 2000 to 2011 or thereabouts. It massively outperformed equities. Then it had a fairly dud decade, and now it's started again. We're now in a new phase of upwards movement, and the reason is simple. Everybody who can read can see that the government debt is not, the problem of the government debts are not being addressed at all.
Now, when it comes to also what is happening in Europe, where you are, I wanted to ask you about this because you recently had a post about the Eurozone and how the euro currency might actually be in decline and not exist in the future. Can you expand on the crisis that's happening in that area?
So some countries in Europe, in their own ways, are in political crisis, and we're seeing that reflected in the interest rates. Now, don't forget, the euro is a single currency. But what we're seeing is that the government bonds issued by different countries in the Eurozone, which were, shortly after the euro came into existence, all converged at more or less one rate. Those interest rates are now diverging. So there are quite large differences, more than 1%, between the perceived safest countries, Germany, for example, and more risky countries like France and Italy, for example. So the interest rates on 10-year bonds and 30-year bonds and so on, and 5-year bonds, doesn't really matter what maturity you take, are spreading out. The gap between the different countries is widening. Now, what that means is that there's fiscal strains showing in these countries. Some of the countries have been spending more than they really should be, more than they're supposed to under the EU rules, and this question marks are starting to arise in the minds of investors. Why would I invest in a French government bond, let's say 3.5%, or 4.5%, 3.5%, I don't know what the rate is now, 3.5%, when I could be buying a German one at 2.5%? I'd go for the German one because it's safer. Because even though I might earn an extra 30% over the next 30 years from investing in the French one, I think my chances of getting repaid in the same currency are not as high. So there is I won't say it's a large fear, because I don't want to panic people about the euro, but there is a growing worry that the longer you go out, the more you have a risk that you're not going to be paid in the same currency as you bought into. You might get paid in Italian lira or French francs. If you're going to get paid in Deutschmarks, you're happy because Germany has got fairly sound finances, but some of the other countries do not. So that's the danger. And don't forget, we nearly saw the entirety of Europe fall apart shortly after the global financial crisis. I mean, if you remember, then we had what's called the pigs: the Portugal, Italy, Greece, and Spain. There was also Ireland in there, which were the interest rates on their bonds were rising at one point very, very rapidly, and they were going to go bankrupt. And in fact, one country did in fact go bankrupt. I mean, they defaulted. They'll deny that, but the fact is, private investors lost most of the money. The only people who got repaid in full was the European Central Bank and the IMF. Everybody else had to go whistle. That was Greece, which was basically forced to default on private investors. So Greece is now apparently a sound country. It's safer than France, according to the bond yields. I don't believe it myself, but there you go. So my point is, it nearly broke apart. And the reason they effectively defaulted on private investors was if they hadn't done so, then the whole Eurozone would have fallen apart then, and the euro would have ceased to exist. So we're back together again, but once again, the strains are showing, and we could go into another crisis at some point. So don't panic, but probably you don't want to be holding too much in cash or euros or fiat currency unless you just need something for your short-term needs.
So do you see the euro then being, I guess, weaker than the dollar? When it comes to fiat currencies in general, it seems like they're all going to be falling at the same time, but definitely be outside of the euro is your perspective?
Yeah, the dollar's the best of a bad bunch at the moment, despite the perceived problems of the growing government debt. And one of the reasons is that, first of all, they're a lot more public about what they're doing about things, even though it's not brilliant. But they have the highest interest rate. Britain perhaps is out there as well, but the dollar is needed for international trade. Despite all the efforts by the BRICS, is not going to go away quickly. They have a huge military force, which gives it a certain strength to the dollar as well. So at the moment, the focus is on those countries which don't have those sorts of things, but do have problems and political problems as well. So, yeah, right now, I would rather own the dollar than the euro, but I'd rather own the Swiss franc than the dollar.
Well, Clive Thompson, we really appreciate your insights today. If our viewers are interested in learning more, they can find you on LinkedIn, and also you have insights on LinkedIn. You have articles you post, I think, multiple times a week. Can you tell us a bit about that?
So I write whatever comes into my head, but it's always financially rated. It could be a story. On one occasion I wrote a story about a man who, in the 1900s, threw himself into a vat of boiling beer after losing his millions, his life savings. He was a very wealthy man in the railway bubble the railway bubble was the dot-com of the early 1900s. So the backstop to the story is all about the railway bubble, and there was a big squeeze on one of the railway stocks, and he was at the wrong end of it. But, other times I write about the Federal Reserve. Obviously, we know the Federal Reserve is in deep water with the losses it's making year after year, thanks to the fact it's paying out more interest than it's receiving from its bond portfolio. The problem is it bought all these bonds a decade ago at low interest rates, but now the interest rates have risen a lot. So the depositors at the Federal Reserve are earning a lot more than it earns on the bond portfolio. And year after year, it's going deeper and deeper into a hole. The capital and reserves of the Federal Reserve have been wiped out many times over now. And unless they can keep reducing rates and rapidly, they're going to keep making losses. So where does that go? So these are the kind of stories I'll write about.
Fantastic. Well, Clive, any last thoughts before we let you go here?
Well, I think stay diversified. Don't have all your eggs in any basket. You may love gold, you may love Bitcoin, you may love equities, you may love property. Everyone's got their pet love. I think it's dangerous to become in love with any one thing. Have lots of eggs in lots of different baskets. So if one doesn't work, the others will.
Fantastic. We really appreciate your time as always. Thank you so much, Clive. You have a good day and God bless.
Thank you, Elijah. And thumbs up from to all your readers and viewers.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 13th through January 20th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.